Hello, everyone. Our next section will cover insurance. Um, the one benefit to this section is I'm going to kind of read through the slides a little bit and just cover what's on there, so we should be able to get through this relatively quickly. One of the things I wanted to start off with on the insurance is a story we'll jump into. When I was teaching a class called Consumer Decision Making, which really was just a behavioral economics class, and if you ever have the opportunity to take a class like that, I'd actually recommend not taking it. Very difficult class, and I don't know if there's a ton of benefit to it. There was some interesting stuff I learned when I taught it, but it can be a very confusing subject because we get into evaluating different options and which one's right versus wrong, or which one is the optimal answers with many decisions. And we cover insurance a lot in that type of study. So, but while I was in there, I use an example so everybody can better understand insurance and its uses and its place. And I thought it was an interesting question present to the students. And the hypothetical situation is if you won, we'll go ahead and change that here. If you won the Megabucks Million Lottery with a lump sum payout of $100 million, what type of health insurance would you want? And I give you four options here on the PowerPoint. The first option is what's called a Cadillac policy. And a Cadillac policy is a health insurance policy. It's just kind of a term that's used in the insurance industry, that a policy that covers everything under the sun. Now, it's very expensive insurance. Can cost anywhere from $24,000 to $30,000 a year. But virtually everything's covered. The limits are extremely high per year, but again, it's very expensive insurance. But it covers everything, all your prescription medication, those types of things. Or would you like policy B that covers most things? It's all right. Definitely could be worse policies you could select. Would you select option C, which is covers very little insurance? Very few claims, just maybe catastrophic injuries, or the last one, which is to not have any health insurance. Now, when I was teaching this class, I used this as a foundation to, again, better understand insurance. And when I asked, it was about 10 students in this class, what health insurance would you pick? And had a few people say B and C and one of that, but the one gal in the class who subsequently now works in insurance, she said, I'd get the Cadillac policy. I'd get the best money could buy. I got enough to pay for the premiums or the monthly payments on it. Why not? I would get the Cadillac policy. And wow, why wouldn't you want more insurance and some of that? And how I explain this to her is that the optimal answer in that situation would probably be D, don't have any health insurance. And the reason that is because with insurance, from a statistical standpoint, you are going to pay more for that insurance than the cash benefits you're going to receive back. So in other words, you're going to pay more in premiums throughout your lifetime if you have this Cadillac policy than what's going to be paid back by the insurance company for those charges or those claims to be paid. So you're not going to receive the same amount. Now, again, that might be dependent on if you suddenly come up with, have catastrophic illness, get cancer, something like those things. But from a statistical standpoint, the insurance company knows if that's likely to happen. And that often is how they determine how much to charge you as a customer for the premiums. And as I was going through this, I actually illustrated how insurance works. Now, there's one fast statistic that you can actually Google this, and it's something like, of all the money that comes into an insurance company, let's say for automobile insurance, the company only pays out something like 2 to 4% of those monies that are coming in. Now, think about that for a second. So, in a given year, if you pay $50 a month for your car insurance, 50 times 12 would be $600. So, you pay $600 a year. You're only going to get back, from a statistical standpoint, between 2 and 4% of that $600 that you've paid the company in a given year. Now, we don't have automobile insurance just for the purposes of making the company money, or we don't have it just for the purposes of covering an accident this year. We get insurance over time because most of the time because we want to cover those catastrophic losses that we can't afford. And that's the purpose usually of insurance. So I ran some numbers to help explain this to this young lady because she clearly couldn't get it. She was struggling, and she again came back to, why would you not want more insurance, not less? So what I did is ran some numbers just to give her a rough explanation of how this works. And if we looked at having about a $250,000 total payout policy in automobile insurance, okay, so this is what you're assured for, and we start dividing out of a pool of, let's say, 50,000 people that are covered under this policy. So we're going to look at this kind of from the standpoint of the company. We can start looking at how much, again, the company is going to pay out. So in these circumstances, if we multiplied the number of $250,000 policies by 50,000 clients or customers that are covered and have these policies, we can find some statistical information through that. The insurance companies use the law of large numbers, and the more numbers they have, or the more clients they have for any given policy, the more accurate they can predict these different events. So when I was trying to figure this out, I thought, okay, I'm going to pull up just some quick numbers to get the idea. First one was I needed to know, what's the probability of being in a car accident? And the probability of being in a car accident is about 1 in 16. Now, if we convert that to a decimal or a percentage, it'd be about 6.25%. So 6.25 people out of 100 in a given year will be in a car accident. So if we multiply this by the amount paying out, which I put here 100%, we can figure out, of that $250,000, how much would be paid out. Now, one of the things to know is this would be in somebody's lifetime. So that's what we're looking at. The next thing I look at is the probability of being injured in a car accident. And fortunately, that's a little less than just being in a car accident, which is 1 in 1,100. Okay, so again, we convert that to a percentage, multiply it by the total policy payout, and we get a number of $227.27. And again, that's what the insurance company will likely pay out at 100%. Now, we have to remember, claims aren't paid out at 100% all the time. Sometimes maybe somebody has a little scratch and they don't need to go to a doctor, so there's no money paid out for that. But I'm assuming that this is at 100%. So in other words, what I'm saying is these total amounts, when we're all said and done, is actually quite a bit less than what I have stated here. So this would be a very conservative numbers, again, from the standpoint of the insurance company. And the next thing I looked at is the probability of dying in a car accident, 1 in 12,300. Now, I want to highlight something here, and that is I am relatively irrational when it comes to driving versus flying, because I hate flying. Don't care if it's a commercial jetliner. I do not like flying, and quite frankly, I have a fear of it. And I think that's interesting because I ran the numbers, or found some numbers the other day, and it's something like between 1 in a million or 1 in 11 million is your odds of dying in a plane crash. And yet, look at the probability of dying in a car accident. It's only 1 in 12,300. But I have no problems at all driving in my car, but I freak out when I get on an airplane. How irrational is that? So, based on these informations and numbers, we can see the based on the probability, this is the amount the insurance company would pay out per person throughout the term of the insurance. Okay, so we're going to say a given year, a given lifetime. This is how much the insurance company would pay out for a person on average. If we split out the claims by the number of people that are insured, this would be the number you'd get. So that would be a total in a 50-year time span. An insurance company for any given insured person, if these numbers were static, the insurance company would pay out $15,868.94. But we got to divide this out a little bit and see, I use the time value of money in here to figure out, well, how much does the insurance company pay out per year? And on average per client, they pay out $66.71. Now, I would imagine some of you pay more than that to the insurance company a month for your car or your automobile insurance premium. And this is how much you're going to get back in a year on average, which doesn't usually actually happen, is $66.71. So the question is, why would you pay a company, let's say $50 a month for 12 months to only receive back $66.71 from them? Now, I look at that and I say, that doesn't sound like a very good deal. So why do we do it? Well, the reality is we don't know on an individual basis whether or not we're going to be in a car accident, or whether or not we're going to injure somebody else, or whether or not we may die or kill somebody else in a car accident. We hope it's not likely, but in the event it does happen, this could financially bankrupt a person. Especially if they were to get sued, it impacts very negatively a person's financial future if in the event this happens. So it's not a very good deal, but that's usually why we get insurance. It's not for these little tiny, if you accidentally chip the paint in your car. It's for these catastrophic events that, again, could have a huge, huge negative impact on you from a financial standpoint. So that's the reason we get insurance. Now, if we go back to this scenario, though, if we have the $100 million, and the question is, what type of health insurance should we get? The answer is you shouldn't get any. Because you have $100 million, odds are you can pay the hospital's bills and everything else directly out of your pocket in the event something were to happen. So, and again, from a statistical standpoint, the insurance company knows when they divide out their claims by their number of people, they, with some certainty, can figure out how much they're going to pay out and for what reason through this law of large numbers. So, again, the answer is you wouldn't want to have insurance if you were sitting on $100 million. And the reason is because the insurance company, you're going to pay the insurance company far more than what you will statistically receive in return from the insurance company. Okay? Now, another way I explained this to this young gal was, think about this for a second. Is sort of insurance a good deal? And I always say, well, the answer is not really. But if you think about how much money comes into an insurance company versus how much actually gets paid out, think about all the people that are employed in an insurance company. And how do they get paid if most of the money that's coming in for premiums is being paid out? Well, you wouldn't have a lot of employees. You wouldn't have a lot of buildings and things like that, because there'd be no way to pay for it. So it's just something to keep in the back of your mind. You don't ever want to have more insurance than what you'll likely need, because I don't want to say you're throwing money away, but you're giving the insurance company money, and your likelihood of getting it back for a claim, and the funny thing is you don't want to get it back, is not very good. So please just keep that in mind. Now, another thing I look at or like to talk about in the beginning is this thing called whole life insurance, universal life insurance, or variable life insurance. These are all what's called cash value life insurance. Now, one of the problems that I saw early on when I was teaching is the number of students that were getting whole life insurance policies, which is problem one. Problem two is that a number of students that were getting insurance, period, when they didn't need it, life insurance. But we're going to talk for a moment on whole life insurance. And what I used to do in the classroom, and I really can't do it very well here, is I would go through the numbers of whether or not cash value life insurance is a good deal. And we say for the most part it's not a good deal, and that's because cash value insurance and how this life insurance works is you pay the company, we'll say State Farm Insurance, a pretty substantial amount of money for the life insurance or the benefit that you get back. Now, the neat part is, though, that this actually gets put into sort of a savings account or gets paid into the policy. So if you want to cancel the policy, you can go ahead and do so. So for a lot of people, when they heard this product kind of being pitched or sold by insurance agents, they'll think it's a good deal because at least they're not throwing their money away. See, with term insurance, which is the other type of life insurance, what happens is you pay usually a pretty low amount every month to an insurance company, and then it's for a certain term, we'll say for 20 years. Now, if you die within that 20-year period, the insurance company will pay back your insurance for whatever the policy is stated at. So if you have $1 million life insurance policy and you're paying a term policy, at the end of that 20 years, if that's the term you've elected to have, okay, you have given the insurance company all that money, and you're not going to get anything back from the insurance company if you live longer than that 20 years. Now, with whole life insurance, the difference is you can get some of that money back, or even a substantial portion of the money you put into it. So for a lot of people, they say, well, it sounds like a better deal. At least I'm not throwing my money away if I'm getting a whole life insurance policy. And that is true. The problem is if you compare getting a term insurance policy, and let me give you an idea of how much you would be paying, just as maybe an average. For a $1 million policy, if you were getting whole life insurance, you'd maybe be paying $1,000 or $2,000 a month in setting that aside for that policy. For a term insurance policy at $1 million, you might only be putting $50, $30, $40 a month, which is substantially less, or maybe $100, but is still substantially less than $1,000 or $2,000 a month to get the same in return. The problem again with that, though, is once the term expires, you've given that money to the insurance company and you're not going to get anything back. But it is a lot cheaper. Well, with the whole life insurance, we run some numbers and we say, how about we get term life insurance and get our term life insurance for 20 years when we'll likely need it, or that's when we have financial catastrophe if a spouse ended up dying. So we'll get term insurance policy. And instead of getting a whole life policy, we'll take the difference between the term policy and the whole life insurance policy, and we'll set that money aside. Okay, so the difference between the two premiums, you set it aside and invest it in a mutual fund. Okay, at the end of 20 years or your lifetime, you would have substantially more by setting aside that money and not giving it to the insurance company, and that's because you would receive a much higher rate of return. The other problem with getting a whole life policy is you don't have a lot of flexibility of using that money. You can borrow against it, but you're tying up your money, and I don't like that personally from an insurance perspective of why would I give my money away and then make it so there's a lot of effort to get it out or use it in the event I need it. And so I struggle with that. And actually, a number of years ago, my wife had an insurance policy that was a whole life insurance policy. And back in the day, Fear was a tactic that was often used to sell whole life insurance. But my in-laws got this policy. I think it was like $15,000 for my wife. In the event she passed away at a young age, this policy would pay the $15,000 to bury her, which I know sounds morbid and bad, but that's kind of why you get the policy. And the other reason is that it was sort of sold on an investment and saving it, and over the years you could pay more into it and get more back and all sorts of other stuff. Well, I ran through a bunch of these calculators you see on the screen here, the actual value of that, and my wife ended up getting rid of it at 33 years old, and she had put in, I think it was about $6,200 was paid into the policy, and again, a $15,000 policy. We ended up getting a check back for $6,400. Now, if my wife had taken that same money and invested it in a mutual fund over the last 33 years or 37 years now, and what would have she received? And I wanted to figure that out. Oddly, it was way more than $15,000. There was another downside to this whole life insurance policy when we cashed it out, is because it was not a death benefit payout. We just wanted to cash it and get the money back. We ended up paying a substantial amount in taxes. And that was because unlike the investment, the mutual fund investment that my wife could have done, about 50% of the amount that was in there, the payout that we got, was considered a dividend. And the problem with a dividend is dividends are not taxed on capital gains tax. Dividends are taxed on a marginal income. And our marginal income tax was fairly high. Very fortunate. My wife has a very lucrative career as an engineer, and I have some money that comes in, fortunately. So we're in a little bit higher of a tax bracket. So to get this money in the form of a dividend, which is, to me, doesn't make any sense, we ended up being taxed on a lot of that, when if we would have invested it in stocks or bonds or something else where the return on it, or most of the return, was a capital gains, we would have paid far less in taxes. So that being said, typically whole life insurance for the most people, average people, it's not a very good deal to get into, and I would warn you when working with an insurance agent that they may try to sell you that. But for most people, term policies are much better and far cheaper. Now, one of the things I also wanted to talk about in regards to that is that when the situations where whole life or universal or variable life, which are all cash value policies, might be worthwhile, is when you're trying to create succession plans in business environments. In those cases, let's say a family farm, sometimes people would pay into these policies and put it on one of the parents in order to pay off a brother or sister that would be inheriting some of this, and that way they don't split it up and liquidate the family farm. So it's a very common practice. In many of those situations, cash value policies might be more beneficial, and they might be useful in those cases. But in a lot of other situations, it's usually not worthwhile to get a whole life insurance policy. But again, there are some circumstances where it does make sense. Now we get into insurance. So some of the different types of things we look at in insurance is risk, and we have a bunch of different definitions. Risk is simply the uncertainty about an outcome. Now, financial risk to me is kind of an interesting thing, because all we're talking about with financial risk is a fluctuation. So if we were to look at stock prices, for example, of General Electric, the more those stock prices fluctuated in a daily, hourly, minutely basis, the higher risk that stock would be. So that's how we measure risk in finance, is just the fluctuation in something. Because when something fluctuates a great deal, it's tougher to predict in the future what the outcome would be. So that's how we measure risk, or that's why we measure risk. So what we're often trying to answer from a financial standpoint, and especially insurance, is how much could we lose and when? We have two types of risk in when we talk about insurance, and one is speculative risk. Now, you can't insure speculative risk where there'd be a potential for gain or loss. If you think about gambling, gambling would be a scenario which would be speculative risk, and again, there's a gain or loss. Insurance, typical insurance, can only insure things that have pure risk, where there's only potential for loss. Okay, we can't insure gains. So we have 5 different ways we can manage risk. The first one is risk avoidance, and that would be don't engage in any high-risk activities such as skydiving. Just avoid them. Another thing we can use to manage risk is risk retention. Where there would always be potential for a loss, we might as well just accept it and move on and just take on the risk. We retain it. So in the case of skydiving, you'd say, well, I'll make sure I pack my own chute, but I'm still going to go skydiving. Another way we can manage risk is controlling loss. And that we try to reduce the severity and the frequency. So in the case of skydiving, we'd say I'll only skydive once and I'll make sure to pack 2 backup chutes. Okay, there I'm reducing the severity and the frequency of the risk. And then we have risk transfer. Now, risk transfer is why you get insurance. You're trying to transfer that on to somebody else. So the risk with skydiving would be the dying. So you'd want life insurance for your spouse if they were to go out and go skydiving. So that buying that insurance would be transferring the risk over to the insurance company from a financial standpoint at any rate. So buying insurance places the risk on the insurance company. So there you'd be saying, I'll still skydive, but if I kick the bucket, my wife's going to be rich. Okay, again, that's risk transfer. Then we have risk reduction. Now, risk reduction is trying to bring the risk down to an acceptable level. So when we look at skydiving, you'd say, I'll still jump out of a plane, but only after it's on the ground. So again, that's risk reduction. Those are all ways we can manage risk. Now, we have different types of insurance or different ways us finance people classify it. And the first one is necessary insurance. Necessary insurance is an insurance that can prevent current and future financial catastrophe, bankruptcy, and worse. And oftentimes this will be mandated. It'll be some sort of legal requirement. Health insurance right now has been mandated. You have to have health insurance, otherwise you'll be penalized. Then we have important insurance, and that's insurance that prevents having to borrow money in the event of a loss. Life insurance, term life insurance might be an example of that. And then we have optional. And optional insurance is that could be covered by savings and is not necessarily a necessity. So having more comprehensive automobile insurance to pay for any of your claims in the event you're at fault, or something happens to the vehicle that you didn't cause, and the other person, there is no other person that needs to pay, would be optional insurance. You typically don't have that. Now, in the world of contracts, if you were to borrow money for a car or borrow money to buy a house, oftentimes those lenders will require and mandate that you get some form of insurance to cover the loss to them. They want to make sure that their assets are covered. So in those cases, it could be normally optional, but then it turns into a necessity. Now, how insurance works for the most part, and again, I just trying to do a quick overview. I know many of you have insurance, you know these terms and understand how that works, but in the event we have somebody that doesn't, we'll make sure that we clarify. Now, how insurance works is you usually get an amount in a policy. We'll use a homeowner's policy that covers, just as a general way of understanding it, the most that will ever be paid out would be $250,000 for a house and other claims on that. So in the event you have a claim, the insurance company will pay that. Now, what you have to do in return is every month or every 6 months or every year, you need to pay what's called a premium. So it's kind of like the monthly payment to the insurance company, so you are covered. Now, typically, you can pay this either monthly, twice a year, or once a year annually. The benefit to paying it once a year or every 6 months is you're going to pay less than if you do a monthly plan. So something to consider. Now, if you do these every 6 months or every year annual plan payment for your premium, make sure you are setting aside money to pay for that. You do not want those premiums to go unpaid and then your insurance lapses. So the next term we have is a deductible. For many types of insurance, the insurance company requires you pay a deductible. Now, that is an initial amount you're required to pay on a claim before the insurance company will pay out anything. So if I caused a car accident or was negligent in some sort of car accident and had some form of comprehensive automobile insurance, and I go to an auto body place and I want some work done on my vehicle to get it repaired, and let's say it's $5,000 and I have a $500 deductible, this means that I'm going to have to pay the first $500 of work done on my vehicle to get it repaired. Once that's done, and again, if I have a certain type of insurance, automobile insurance, after that, then the insurance company will pay the remainder of that claim. So that's what a deductible is, and for most insurances, we do have a deductible. Usually, the higher the deductible means that you'll pay a lower premium. Another wonderful reason to have a lot saved up in an emergency fund is in the event this happens. Again, the higher your deductible, the lower your premium. Couple other terms. The policy. The policy is the terms of the insurance, and it sets the limitations on the insurance, and it's basically the paperwork and tells you what you're covered for and what amounts. Another term you want to be aware of is something called coinsurance, which means each party, the insured and the insurer, pay a percentage of any claim. You might pay 20% on a health insurance claim, and the insurance company will pay 80% of each claim. Then we start adding in deductibles and other things, and then it can get all sorts of confusing. Now, in this insurance overview, I could get into some real technical stuff. We could run formulas and see how this exactly works. Just know that oftentimes it's not as simple as what I may be making it out here to understand, again, like coinsurance, whether or not you'll be paying 20% and then doing the quick math. It's more of a formula than that. We have some adding, subtracting, and dividing. But I'm not going to get into that for the purposes of this class. We're just trying to get an idea of what insurance is, some of the terms, and what you can expect. Now, the folks that sell insurances, there's three types we're going to talk about. The first one is an independent insurance agent. Here in Brookings, Holly Insurance Agency is what's known as an independent insurance agent. Now, the independent insurance agent his job is to match the client with the company they think best meets the customer's need, very often on price. So at Holly Insurance here in town, you could get Progressive, you could get, I don't know if State Farm is included or they don't think they do theirs independently. You could go get USAA insurance through Holly Insurance Company. They sell multiple companies. Typically the benefit is they can get you lower premiums because they can pull them from all the different types of companies. Then how they get paid is they receive a commission from the insurance company. Then we have exclusive insurance agents, State Farm, Farm Bureau, Farmers Insurance. A lot of farming going on in the world of insurance. These folks are what's called exclusive insurance agents. They only sell insurance from those companies. They won't sell you insurance from Progressive and other types of insurers. They only do so for their company. Then we have a direct seller who sells insurance, and typically they don't use externally placed agents, so you won't see one of these companies selling here down on Main Street. Instead, they're going to use other methods to obtain clients. They'll typically sell it from a call center of some sort. So the different types of insurance we're going to talk about in here is homeowners insurance and liability insurance, life insurance and disability insurance, auto insurance, and health insurance we'll barely touch on. Again, we just want to get a rough idea of what we're talking about. First thing we'll talk about, a few notes on homeowners insurance and renters insurance. Now, homeowners insurance, the first part of it is to insure the dwelling. And if you have a mortgage, the bank's going to require you to have it insured. That's done by placing it a monthly insurance payment in something that's called an escrow or escrow bucket. So when you're paying your monthly mortgage payment, what will happen is a portion of that, I'll use the example of my mortgage is $1,200 a month, and about $150 of that is being set aside by the bank to pay off annually the homeowner's insurance policy. And again, that's put in what's called escrow. So the lender, my bank, will then pay that once a year for me. I don't have to worry about it. Now, they're also going to do that with the taxes. Set amount every month that I'm paying my insurance is going to be set aside to use to pay the taxes, property taxes here in South Dakota on my property. So usually those monthly payments are broken up into four categories or four payments, and all wrapped into one, so you don't have to sit there and do any math or do that. But it's called a PITI payment, which is principal, interest, taxes, and insurance. So a portion of your monthly mortgage payment is going to pay the principal on the loan. Another part of it is going to pay the interest on the loan, and then another portion to taxes and insurance that the lender will pay usually once a year. Again, that's called a PITI payment. Very standard. Now, you can pay your own taxes and your own insurance. You don't need to use the lender. The problem with that is, one, the lender's going to want to keep tabs, a little closer tabs on you, because they want to make sure the taxes and insurance get paid on this. It's in their best interest, because in the event you aren't paying your taxes, well, the government can kind of come after you and try to take your property or put a lien on it. And the person that holds the mortgage, which is the bank, doesn't want that. With insurance, they want to make sure that property is insured in the event it burns down or something happens to it. They want to make sure they get that paid back. So that's why they use this escrow thing. And I would recommend using escrow and escrow buckets and not paying any of this stuff on your own. Far easier just to go through the PITI payment through the bank. Now, homeowners insurance, the purpose of that is to insure the property inside the dwelling. Now, this is for your personal property that could be damaged due to the unforeseeable events. You'll want to work with your agent to determine what items you will specifically want to cover in the policy, and make sure those items get written down. One of the pieces of advice I've heard is to take your smartphone about once every 6 months and go around your house and video virtually everything in there. And in the event your house burns down or something like that happens, you have record then. If you save that, you will have record of everything in your house. So when you have to make a claim and show what's all in there, you have a record of that. 20 years ago, they used to say, well, make a list and do all that. And I don't think most people did that. So it's just easier to use your smartphone and record it. And then once you get it recorded, you may want to save it externally, email it to yourself if you use like Yahoo or Gmail or something like that, so there's a record of it that you can download at a future date. Remember, don't forget items that are valuable, such as expensive jewelry and antiques. You want to make sure those are covered in your homeowner's insurance policy. All right, other portions of your homeowner's insurance. That was insuring, again, the dwelling. Next part of your homeowner's insurance is what's called liability or liability protection, and this is the portion of the homeowner's insurance that deals with what would happen if someone was hurt on your property or your property, or you did damage to somebody else. Again, that's another portion of your homeowner's insurance policy. Couple tips on that is the amount covered on the policy is usually yours to decide, as long as your property is covered and everything's covered in that from the standpoint of the insurance company. Be cautious, though, of insurance agents trying to sell you too much insurance. Now, that being said, it's estimated approximately 35% of homes in the U.S. are actually underinsured. Now, there's a principle that's often used in insurance called the principle of indemnity, and that prevents you as the insured from recovering more than what was actually lost. Okay, you can't get more insurance or money back if you didn't experience that loss. So if I have my house insured for $300,000, and my house is only worth $200,000, I'm not going to get a paycheck if my house burns down for $300,000. Now, I might get $260,000 if I have it set up correctly under my policy that I paid out in order that I can replace my house with a similar like house. That would be newer, probably cost a little more money. You can do that, but you can't collect more from the insurance company than what was actually lost. Now, agents can't sell you substantially more than what your property is appraised at. They get audited, and they usually are prevented from selling you way, way too much insurance for your circumstance. So what we mean by that is if you have a $100,000 home and you try to get a $300,000 insurance policy, the agent's not going to be able to sell you that because it would get audited, and the auditors in the insurance company would say, something doesn't smell right here, and they would bring it down to a much closer level. That being said, if you had a $100,000 home, you could insure it for $120,000. So you can get a little more insurance from that. Now, it probably is not going to cost you much more to insure it for $120,000 if you have a $100,000 home. But remember, with all of these add up, and you have higher monthly payments based on this. So you want to get the right amount that recovers any possible loss. You don't want to get too much insurance. So make sure you do your own research and shop around. Also, last year, I believe, Consumer Reports rated USAA, if you are a veteran, to be one of the best insurers. They were far less expensive. Again, if you're a veteran or had a family or relative that's a veteran, USAA has much lower insurance, and their customer service was actually rated #1. So just a helpful tip out there. And this was in 2015, so in the event you're watching this in 2020, that may have changed by then. So again, do your own research, determine what and how much insurance is right for you. Some amounts will be required by law or required by a lender if it's for property. I strongly advise getting online and using any reputable calculator. For things like life insurance, you're probably going to, the better way to do that is running a financial calculation to see how much would be right for you. And we'll talk about that a little later on. Also, big thing to check when you're looking at your property insurance or homeowner's insurance is double check whether or not you need flood insurance. Now, your insurance agent and the lender should be checking up on this, but this can be a very big problem if you ultimately you're in a flood zone and you don't have flood insurance. The insurance company is not going to cover you for that, and this becomes a very big problem. So when you're working with your insurance agent and your lender for buying a house, double check to make sure what zoning you're in and if you're in a flood zone. Then we have renter's insurance. Now, renter's insurance is for renters. So if you rent an apartment, you may want to consider getting renter's insurance. And what renter's insurance does is it covers personal property and a person's liability or personal liability in a claim. So if I accidentally injure somebody, I'm renting an apartment and I accidentally injure somebody because I didn't clean up a mess or something like that, then my renter's insurance would cover that. The other thing it will cover is in the event there's a fire in the building, okay, whether or not I caused it, I can file a claim to cover any of my own personal property. Unfortunately, renter's insurance, especially back in the day, was sold by insurance agents with a scare tactic in saying, well, you want to make sure you have renter's insurance because if you burn down the whole apartment complex, the landlord's going to come after you, and if you don't have insurance, you're going to have a big problem. Well, that's not necessarily true, okay? With renter's insurance, it only covers your personal property. In the event of if you caused a fire in the landlord, okay, the landlord has their own renting or their own commercial insurance policy that covers the apartment complex. So, again, even if you cause the fire, hopefully the landlord's policy will cover it for the rest of the building. It won't cover your personal property inside your apartment, however. Now, as I said, the landlord should have their own insurance to cover that. The downside is your landlord's insurer can come after you or your insurance company, a process that's called subrogation. If you caused the fire, maybe were negligent or something like that, and caused the fire, their insurance company can come after you. But that's called a process of subrogation. And I don't want to say it doesn't happen very often, but again, I will say that the landlord should have their own insurance to cover for those damages. We're going to go ahead and I'm going to split up this video and do a couple of them on insurance. So in our next video, we'll pick up at life insurance.